We always say retirement plans, they don't fail, they just simply adapt.
Welcome to another week of Real Personal Finance. I get to welcome our new co-host, Nick. Hi, Nick.
Scott, how you doing? Good to be here.
Man. Maybe introduce yourself to the podcasting world.
Yeah, absolutely. Nick Covyeau, certified financial planner, owner of Swell Financial in Costa Mesa, California. So just down the street from you, a little drive. And we focus on working with retirees and those getting ready for retirement and working on how much you could spend and what life's going to look like in retirement, all those fun things.
Yeah, and we talk about that a whole bunch on the show. So perfect. Excited to have you here, man.
Thanks.
And speaking of retirement, one of the most common questions that we get in our practice, doesn't really matter where you are in your path to retirement or making work optional, is how much do I get to spend in retirement? So a good opportunity to lay down how we think about that and how you can think about that.
It really applies to everybody, right? Whether it's going to be a long retirement we're planning for or, a shorter one where you want to end up working longer. The idea here is it's yours. You can make it whatever you want it to look like. And so we love diving into, what brings you joy, purpose, fulfillment, all those types of things. And then we'll handle the financial side. And that's what we'll dive in today is what's your number? How much can we spend? And how do we arrive at that, right?
There's a number of ways to kind of figure this out. When we work with clients, basically when people are asking how much do I get to spend in retirement, they're almost always thinking about their portfolio. So they've built up maybe 401k assets and some taxable investment assets, maybe a Roth IRA. But there's also a part of the equation, we won't focus on it too much today, but a portion of the equation is just, of course, like if we had a pension, maybe through military service, or if we have Social Security, which pretty much everyone still has to this point, those are going to be included in the amount of money that you get to have to spend. But I think a lot of people are asking the question of what can I safely withdraw from my portfolios to live in my retirement? So that's what we're today.
I like to look at it too of like solving for the problem by working backwards, right? And so all the things that you just said of like pension, Social Security, those type of things, right? Once we figure it out and solve for how far that's going to take us, traditionally we have a little bit of a gap, and that gap then is going to come from our portfolio. So how much do we need to have saved? And so once we get an idea of how much we're spending, whether it's $5,000 a month, $10,000 a month, we start to kind of back into that math of how far is our portfolio going to take us. I like to use, there's a couple back of the napkin equations. I'm sure everybody's heard of the 4% rule, which is just taking 4% of your portfolio as your starting withdrawal rate, right? We're adjusting for inflation every year. So you can take a little bit more, right? To meet those living expenses as the cost gets more expensive.
As an example, then, if I have $1 million portfolio, I can take $40,000 out of the portfolio this year. And then if there's a 5% inflation, then I get to take 5% more. So 40 grand plus 5% more, 1.05% gives me that 5% bump. And I can do that. And that's designed to do it for like 30 years.
Yeah. And I think that's a good starting point. I think it's also important noting that depending on where markets go, right, that's going to keep your retirement afloat, but it doesn't also necessarily mean that you're going to have much left at the end. It just means we have a 30-year retirement. We have enough money. And historically speaking, depending on where markets are at, we're fine. And so I enjoy using that as a baseline. But something that I've really enjoyed recently, and I'm not sure if we've talked about it before, is the Guyton-Klinger approach, where it's known as the guardrail approach, which tells us we could have a higher starting withdrawal rate and adjust as needed. Because life's, right? Life happens. We have to adjust depending on what happens in the market. And so when that happens, it tells us we could spend more when markets are good. But when things happen and markets go down, well, we should probably tighten up or cut back our expenses a little bit.
Yeah, that's a smart idea. So, and the idea that 4% rule that we were talking about before, that research was originally done by a financial advisor back in the 90s named Bill Bengen. And basically what he did was he said, okay, if I have a 60% stock and a 40% bond portfolio, and I take the data as far back as I can to 1926, when we
Mm-hmm.
started to have financial data, what percentage of my portfolio can I withdraw without running out of money in a 30-year time period? And actually, in like 1926, the answer was actually a 7% rate of withdrawal,
Okay.
right?
I didn't know that.
It was a really high written number. And if you think about it, like sometimes you'll even hear people like Dave Ramsey will say, like, you can have a 12% rate of return on the stock market and take 8 out every year. And a lot of people in our space, especially advisors, are like, that's so dangerous. Be careful. And we're right. It is dangerous, and be careful. You don't want to run around with that. But the point is that what happens is sometimes you have hit market cycles where you can actually take way more out and be okay. What Bengen was interested in looking at was, what's the maximum amount we can withdraw from the portfolio and not run out of money during that period of time? So never have to worry about running out of money. And that answer was actually not really 4%, which is what the media quoted him on. It was more like 4.5%, right? So like, that's a decent place for you to look for, like, how much can I withdraw when I turn a certain age? So you got to think about, like, how much am I saving now? Maybe I have $1 million right now and I'm in my early 50s and I'm going to work 15 more years. Well, you're going to have to give it some type of a growth rate to get a projection for what's it going to be worth in the future. Plus you're saving every year more money. So you got to include that. It's going to build to some dollar amount and then take 4.5% of that number. That's really what you get to withdraw when you turn 65, right? Does that make sense?
Yeah. And, I think what I love about it too is it's adjustable, right? It adapts, right? We always say retirement plans, they don't fail. They just simply adapt. And so when we have really good numbers, good years like we've had in the last couple of years, then we tell our clients, hey, you could actually afford to spend more. And I think that's the beauty, whether you need to have it or not, knowing that you could afford to spend more is really nice. I think a nice comfort to be able to have, as opposed to I'm beholden to this set number and I can't go above or under those types of things.
Yeah, I think you're making a really good point. Like Bill Bengen's idea was, hey, what's the number we need for 30 years? You set it and then you just step it up by inflation. So it never changes.
Yep.
So it's almost set it and forget it, right? Like the Ron Popeil rotisserie thing from the 80s. But so like, the Guyton Klinger, who you were mentioning before, we use Guyton Klinger as a baseline with a lot of client discussions as well. Not that clients can't choose to take less, they can, but like where, Bengen is essentially saying, hey guys, take 4.5%. You're done. So if you have $1 million, take 45 grand, right?
Right.
Klinger and Guyton basically came out and said, like, hey, hold on a second. Like, if clients are willing to start with that $1 million and take 5.4%, say, so 54 grand. And every year or every along a certain period of time, we're just going to check and see how much is that withdrawal rate compared to the size of the portfolio. And so long as it doesn't get to be too big of a number, we're going to say, keep taking that same amount.
And that's the most important part right there, right? As we continue to have those check-ins periodically of how's the market doing, how much are we spending,
right?
Where are we within that benchmark or those guardrails?
Right.
We're good to go.
To your point, they're creating guardrails. So a guardrail just really means, it doesn't mean what's the value of my portfolio exactly and what did it go up to or down to. It's actually looking at the percentage of withdrawal relative to the portfolio that you're starting with. And so long as you're in a safe band, it's just going to say, hey, keep taking the same amount or take the same amount plus inflation, just like Bill Bengen did back in the 90s. And then it's going to say, ooh, you know what? Actually, we just had a downturn. So let's choose to take 10% less out of the portfolio right now. And like, think about that for a second about why would we do that? We would do that because when markets go down, typically they're going to recover on the backside. And we need time for them to recover. But if we take more money out during the recovery, it makes it harder and harder to dig yourself back into the size of portfolio you had before. So by choosing to take less for a little while, you allow the portfolio to right itself.
Absolutely. Like I tell clients all the time, when we're forced to sell during a downturn, we're robbing our future portfolio the ability, right, that purchasing power to ever fully recover, because now we're having to sell when it's down, right? It's,
Yeah.
the idea of like selling low, right? We don't want to do that. We're trying to avoid that. The other thing that I wanted to kind of talk about too is our spending and how that changes in retirement. I think what
Mm-hmm.
Bengen really gets at is that we're going to continue to spend the exact same amount adjusted for inflation. I don't know about you, Scott, but I find that wildly kind of out of left field when it comes to my clients, because there's big trips they want to plan for. There's
Right.
new homes they want to purchase. Life happens, right? And so what we traditionally see too is, and there was a research study done on this. I think it was Kitsis or his team that kind of quoted the go go, slow go, no go years, where we tend to see
Mm-hmm.
a lot more spending in your late 50s, early 60s, 70s than we do in our 80s or 90s, right? And so
100%. Yeah.
there's a lot of assumptions baked into that as well, where if we're going to spend more in retirement up front, we probably have to make some sacrifices in the later years.
Yeah. And if any of you listeners ever want to be really nerdy, there's a podcast and a website called Nerd's Eye View, which is something that we as advisors look at all the time. It's 5,000 to 10,000 word articles about very, very detailed topics, one of which Nick's pointing to right now. And it's what we see in our own practices, right? So for
Right.
clients who are retired or near retirement, what we typically see is that we spend more in the earlier years of retirement than we do in the later years of retirement. So that's kind of, again, why going back to the Klinger-Guyton idea of dynamic withdrawal rates makes a lot of sense, because it lets us take more from the portfolio now, still builds in an ability to make sure that we dampen withdrawals to help make sure we have a 40-year time frame for withdrawals. So there's plenty of time to make sure you're okay.
Yeah.
But it also allows more of that money to get spent on the front end, which just makes a ton of sense, because you don't get to take it with you, right? This isn't about, if it is about leaving a lot of money to your family, you probably want to lean more to like a static lower withdrawal rate. And then we can just invest more in the stock market beyond that,
Right.
to get more money to your family. But that's like an individual choice for people who normally show up, who need money to live life. I think this is a good way to go.
Right. And the same to be true too, depending on the time of retirement, like that length that we're planning for, those distribution rates are going to change. If you're, financially independent, want to retire early, the fire community, and we have clients want to retire in their 40s or 50s,
Yeah.
the number's probably going to be a lot smaller, because we got to make sure there's enough to get you through that long of retirement, as opposed to clients that say, you know what, I really enjoy my job and I want to keep working well into my 70s. And so, the famous answer, it just depends.
That's a great caveat to bring up, because the all of the research that has been done on whether it's Bill Bengen and the 4% rule, or it's the Guyton Klinger guardrails approach, they're all designed to deal with either 30-year timeframes or 40-year timeframes. So if you are in your 40s and looking to retire, quite honestly, with the way that medical advances are occurring and the way that the average life expectancy is happening, you're probably going to live 50 to maybe 60 years in retirement. So you really need to adopt more than likely a lower withdrawal rate to make sure that you have those funds through those periods of time.
Absolutely. And when we look at this too, I think the 4%, the 5 points, whatever the number is, I think there needs to be a clear disclaimer as well to say, like, that's everything when it comes into our spending. So there's a lot of things people often leave out, whether that's adjusting for taxes or inflation or healthcare, any other big ticket items you could think of, or things that people traditionally leave out when we think of what our expenses are going to cover when we start pulling money from our portfolio.
Yeah. And another thing that people, it's something that you don't realize until it happens, but a lot of people will go and will make a plan, like my wife and I. In my head, my plan is we're going to be together until the moment we both die, like in the Notebook.
Of course, like the Notebook. Of course.
It's going to be super simple. But what ultimately ends up happening for a lot of folks is one spouse dies, usually the husband. Usually it's what I've seen in my career is normally what happens. But what we often don't have, spouses may not be prepared for, is that they flip to filing single
Mm-hmm.
after a year. So you get to be a widower for a year on a
Right.
joint tax return, but then all of a sudden you're on a single tax return. So your taxes can actually jump
Yep.
pretty dramatically if you have really large portfolios, especially if you have to still make large required minimum distributions. And that affects things like this other word called IRMA, which
Oh
basically
yeah.
just means what do you pay in Medicare taxes. So there's a lot of planning that can be done to help mitigate those things, but it's just stuff to keep in mind.
Yeah. And like we talked about earlier, the 4% rule, it assumes a 60-40 portfolio that you talked about earlier, 60% stocks, 40% bonds. But it is really interesting when we start, nerding out for a moment on how we would invest when we're retired, right? And if it's retiring in our 40s versus our 60s, and the role that what's called asset allocation, stocks to bonds, what that plays. Because
Yeah.
oftentimes we have a lot of clients come in and say, hey, I'm ready to retire. I don't want to lose this. This is all that I have. So therefore, I want to be really conservative. And what's
Right.
really interesting is when we start to look at the data and the research, well, we do need to take on a healthy amount of risk to outpace inflation because there's money that we're going to need for today, but money that we're going to need 20 years from now. And so, how do we balance that? Because a lot of the
Mm-hmm.
studies going to say if we're too conservative, we're really going to have to adjust our spending because we're not going to get that growth.
Absolutely. That's something that conversations that we have all the time. And that's actually another thing that I really enjoy about getting to work with people who are retired is that I always view it like our job is to help turn on a stream of cash flow
Yep.
that you shouldn't have to worry about.
Mm-hmm.
That's our job to worry about it. But to your point, what you're getting at is the cost of now that I love that I'm old enough now that I can think about this because like my 12-year-old son's going to start he just turned 13, I should say. So he's going to start going to movies and going to dates and doing all that stuff. And it's like, I used to be able to go on a date in high school for $20 to a movie theater. Right. Well, now you can't even get a ticket for $20. Now that's only 20 some years ago. That's not a long time ago. So that's in the same lifetime of a retirement phase, right? So
Mm-hmm.
you have to realize that all that inflation is going to happen. And when it does happen, just investing in cash and bonds isn't going to keep up. You
Right.
have to invest in stocks. And by investing in stocks, you're basically protecting yourself from
Mm-hmm.
purchasing power parity, right? Whatever the cost of that ticket is 25 years from now won't be a problem,
Yep.
right? You got to have it. But at the same time, you do want to have a war chest. You want to have some funds that are set aside that are relatively stable, that are available all the time so that when the downturns in the stock market happen, you don't have to worry.
Right. You're completely isolated. Like you're unaffected, unimpacted, right? Where we just get to separate those two, where it's like, hey, I love the idea of that word war chest, right? And just think of like this like Fort Knox, where it's just like, all right, we have our cash, we're ready to go. If there is a downturn, that's okay. Because guess what? We have years traditionally, depending on how people choose to view it,
Yeah,
worth of living expenses where we could say, let stocks do what stocks are going to do. We know they're more volatile. There's still a reason we invest in them. They're giving us that long-term growth. But guess what? We have multiple years to be able to live off that without, regardless of what happens in the market.
absolutely.
Yeah.
Cool. Well, yeah, that's the geekiness of what do you get to spend in retirement? What's a safe withdrawal rate? I hope that was helpful for you guys.